Hello, everyone. I'm Peter Van Beek, and this is Matt Sutner. We are both advisors here at McGlone Sutner Wealth Management. Today, we'd like to welcome you to our client-exclusive Quarter 4 update. Today, in just a few quick minutes, we'll provide an update on two of the biggest topics currently surrounding us, which are interest rate environment. What do interest rate changes mean for you? And with it being an election year, what impact does that have on you in the markets historically, both pre and post-election? Matt, would you like to get us started on the conversation surrounding the interest rate environment and those changes?
Yeah, thanks, Peter. The interest rate environment is dictated by the Federal Reserve. The Federal Reserve is the organization that basically sets the floor on all of lending institutions. So if you think about your mortgage, or if you're getting a vehicle, or if you own a business and you're building a new building and you need some financing, that number that the banks are lending to you is dictated by the Federal Reserve federal funds rate. And that's what you see on the screen here. That federal funds rate is basically the floor, like I mentioned, and the banks add their margin on top of that so that they can make money and stay in business. And that's how those rates are set. So when you're looking at getting a mortgage today, that's why mortgages are, a little bit higher or a lot higher than they were 3 years ago, because the Federal Reserve had raised interest rates and the banks followed suit, right? So what you see on the screen here is basically the last 10 years of the federal funds rate. And you can see that there's been some fluctuations here. Now, if you look at 2020 or 2015, the number was nearly zero. It was almost zero. And the reason is that in the 2008 financial crisis, the Federal Reserve brought the rate down to stimulate the economy. When rates are low, it's a lot less costly to borrow money. Well, as you can see here, they started raising it back up a little bit from 2017, call it, through 2019. And then you see a steep drop off in 2020. Well, we all know what happened in 2020, right? COVID happened. So when COVID happened, the market really struggled because no one was working, and we can all attest to what happened in 2020. So the Federal Reserve reduced the rate down to nearly zero again to stimulate that economy. However, by doing so, the government also printed $6 trillion and basically gave it away, right? So they created $6 trillion out of thin air, essentially. What happens when you do that is it creates inflation. So when you're looking at this graph on inflation, you can see in 2020, it was nearly zero because no one was buying anything. No one was traveling. Everyone was shut down. But as you get into 2021, you can see that inflation starts to spike. And into 2022, in June of 2022, it actually hit 9.1%. And one of the levers the government can pull is going back to that federal funds rate and saying, all right, we need to raise the interest rate to quell or slow down that inflation. When you raise interest rates, things become more costly, and therefore it slows that economy down. And so that's what they did. You can see in 2022, they started raising the rates. And by the middle of 23, it had gotten all the way up to about 5.5%, 5.25, 5.5. And they left it there. They called that the terminal rate. That's the max ceiling that they were going to hold it there, right? So that's what happened in 2023. And fast forward to today, inflation, if we go back to that inflation slide, you can see inflation has come back down. Now, their target was 2.5%, and we've gotten there basically a couple months ago in August, September timeframe. With that said, the Federal Reserve reduced rates in September by 0.5%. Well, that's really good, right? But what does that do to your portfolio? So one of the things I wanted to talk about was the bond interest rates, right? So interest rates are part of the bond portfolios as well. Well, most of our clients have bonds in their portfolio, and there's an inverse relationship. As interest rates go up, bond values go down. As interest rates go down, bond values go up, as you can see on this slide here. So when we were in 2021, for example, and interest rates were nearly zero, we knew they were going to go back. They're going to go up at some point. They can't really go much below where they were. And so when interest rates go up, bond values go down. So we positioned our clients' portfolios in more of a short-term bond position, because if you look at the length of these arrows on the screen here, the short-term, mid-term, and long-term, the shorter-term bonds are impacted less than a longer-term bond when interest rates go up. Now, the opposite is true when interest rates go down. So when the Federal Reserve said, hey, we're at 5.5%, and that's the max, we're probably going to, at some point, reduce that rate. We shifted all of our clients' portfolios from a short-term bond position into more of a mid to long-term bond position to capture that greater upside. Two things: capture that upside, and the second one was lock in those better interest rates for a longer term.
Yeah, that's great information. And as you kind of, as we transition here from the bonds to the stock market as well, I think Matt talked about it here. It's a great thing. Is a big question is from clients that we get all the time is, should I be pulling my money out during elections, or should I be extra worried about my investments during election years? Depending on who wins, that's another question. So if you take a look at the slide here that we have on the screen for you guys, market returns during presidential election years, you can see since 1926, we've had 24 presidential elections with 20 positive years and 4 negative years. So really this just emphasizes the point of, we always say, don't try to time the market. It's not timing the market, it's time in the market. So we'll have a lot of people that'll ask, should I be pulling out during election years, or should I be doing some type of shift? Remember, this is a long-term focus. This is a marathon, not a sprint with you guys. And you can see here, more often than not, it's obviously not a guarantee of future results, but more often than not, we have positive years during election years. And the average return is 11.6%. I think most people would take that for an average annualized return.
And as of this year, it's positive again, right?
Exactly. Yeah. Positive. And it's higher currently at the moment than that average return even of 11.6. And kind of just to emphasize here too is whether you lean left or right, you're in the middle, there is no correlation typically between the party elected during these presidential election years and the average return here. So as you can see during election years, we'll step back at, you can see the average return of election years is 11.6, like we emphasized. The average return of all other years is 12.4. So a little bit lower. And like we said, a little bit higher volatility, but not a huge difference here of non-election years versus election years. And really, like we said, main point here, 20 positive years, 4 negative years only during these 24 presidential elections.
So it does have an impact. It's just not dramatic like most people kind of tend to think it is.
Exactly. And you can even see here, like the highest and lowest returns they have on these. There's obviously volatility in all years of the market, whether it's an election or not election, but not a huge change. There is some change, but not a huge amount. And then a big thing to also stress here too is people ask, well, depending on who wins, what's going to happen, not just what happens during an election year. This shows annualized returns during presidential terms, not just during election years. And really what we want to show you at this slide is no matter the president here, again, there's really no direct correlation of market performance to what party is the sitting president. And that's just a big thing we want to show you guys there.
So one of the questions that I think people are asking is what happens if the president and the Congress, meaning the Senate and the House, are all elected from the same party? Has that had an impact on, how the returns look like over time or not?
Yeah, great question, Matt. So really the last thing we want to talk about with you guys, what Matt just hinted at there, is this last slide shows the average return when a party controls presidency and Congress. So if Republicans or Democrats have controlled the presidency, the Senate, and the House all at the same time, what does that look like? So since, again, 1926, there's been 13 years where Republicans have controlled all three, and there's been 34 years where Democrats have controlled all three. And it's actually crazy. The average annualized return during these 13 years and 34 years, exactly the same to the 100th of a percentile, 14.52%. So really, again, just emphasizes even during total party control or who's elected president, whichever side you side with, there's really no direct correlation between market performance and those parties. So again, that just ties us back to really our investment strategy is long-term investment strategy. Don't think short-term. I mean, this is a marathon, meaning, hey, this is your strategy for 15, 20, 30, 40 plus years, a 3 to 6 month, even a couple year window. That's a small blip on your whole financial radar for your lifetime. And you worked hard to get yourself in this position. And let us work with you guys. If you have any further questions or concerns, reach out to your advisor or shoot us an email. We're more than happy to talk to you guys on the interest rate change environment or presidential election years or election terms, impacts on markets, your investment strategy. More than happy to have those conversations with you guys.
Yeah, we hope you enjoyed the Q4 market update. Thank you so much for watching. We truly appreciate the trust that you put into our office here at McGlone Sumner Wealth Management. If you have any questions, please do not hesitate to reach out to your advisor.
Thank you, guys.